Hey gang, what's going on? Hayden Crabtree here, coming to you on a beautiful Atlanta summer day. I had to get outside, had to get out of the office, but still wanted to bring you some good content. So the topic of today's video is what are commercial real estate loan rates? So we're going to talk about the different prices you're going to pay for money whenever you're going into commercial real estate. So the intention of this video is really to talk to you about the different kinds of commercial real estate loans, because there's a number of different commercial real estate loans, just like there's a number of different residential loans. But I'm going to try and help you talk through all the differences, understand the different mechanisms, because when we get into commercial real estate, we have a lot more options. Okay, residential loans are generally all pretty much the same. We say, hey, we're going to go buy a house for $500,000. The bank's going to lend us $400,000, and we're going to pay this off either over 15. We're going to pay it off over 30 years. Okay, and so those are pretty simple. Obviously, whenever we pay it off over 15 years, what's going to happen is that our mortgage payment is going to be a lot higher. Sometimes our interest rate is going to be a little bit less, and vice versa for the 30-year. Whenever our payment is going to be lower, our interest rate is going to be a little bit higher. But that doesn't matter, right? So whenever we jump over to commercial real estate loan, the first thing I want to talk about is it is going to be more expensive. Okay, commercial real estate loans, unless you are a huge investor, that like somebody on Wall Street, a company that owns billions and billions of real estate, you're going to pay more money for a loan, a higher interest rate than you're going to in residential real estate. So let's talk just general numbers. If in today's market, July 2021, commercial real estate loans are going to be somewhere between the 4 and 5.5%. Sometimes they're going to be a little bit lower, but overall they're going to be a little bit more expensive than a residential. Right now, residential loans are probably around 2.5 to 3%, depending on who you are, where you get your loan from, how long of an amortization schedule you get on it. You're going to be paying anywhere from 2.5 to 3%, sometimes 3.5, I guess, if you have bad credit. But let's just call it 3% is where the market for residential loans is. Well, commercial loans are going to be at least a point higher on average. I'm going to say 4% on average. You'll see some in 3.5%. You'll also see some higher. So for instance, I was looking at a storage facility a couple months ago, maybe a couple weeks ago, sorry, and I got a quote on it for 4.25%, which I didn't think was bad. Another bank quoted the same thing at 3.99%. So we had a 26 basis point. The difference in that is called basis points, right? 1% interest is made up of 100 basis points. So in terms of a loan, if you're going 0.25%, that'll be 25 basis points. It's also called BPS, 25 BPS. You'll also hear it called BIPS, right? BPS, BIPS. So it's all the same thing. We're just breaking down one interest point into 100 different increments to go over that. So that was 26 BIP difference, right? So that was for just a normal bank on a 20-year amortization schedule. I got 3.99, I got a 4.25. I also went to my SBA lender, and so I asked my SBA lender, what are your rates? And so they give me a price, because this is the way the SBA works. They have floating interest. So they tell me, hey, you're going to be at 225 bips plus LIBOR, right? So LIBOR is London International Bank Rate, so it's how much banks are paying for money. So that's pretty much the baseline. And so if we as investors are going to borrow money from a bank, the bank is going to sell us the money at whatever they're paying for it plus some other costs. So whenever they tell me it's LIBOR plus 225 bips, if LIBOR is at 3%, well, 3% plus 2.25, that's going to be 5.25%. And so if the interest rate changes, if the interest rate goes down from 3 to 2.5, then I'm also going to go down 50 bips, right? Now, if the rate goes up, if it goes from 3 to 3.5, then I'm going to be paying 50 bips more, and my interest rate is going to go up from 5.25 to 5.75. And so you really don't run into this in residential. I mean, we used to see a lot of adjustable rate mortgages, ARMs as they call them, ARM, adjustable rate mortgage. There used to be a lot more ARMs than there currently are. And so whenever interest rates in the market would change, then your interest rate you're paying would change, and therefore your actual mortgage would change. And so we can see whenever you do have an ARM, adjustable rate mortgage, we can see that changes monthly. Sometimes they change monthly at the end of every single month or the first of every single month. Then your rate will change, or it could be quarterly, or it could be annually. So these are all things to know whenever you dive into the commercial world. Is if I am getting an ARM, how often is it resetting? Where are we at in the interest rate market, and how is it going to change? See, right now we're at pretty much the lowest interest rates in history, and it's be pretty hard for them to go any lower. And in fact, we're already in real negative interest rates. So what that means is if our interest rates are 1%, inflation is 2%, we're really borrowing money at a negative 1% rate. And so we're already at real negative rates, but if we want to go to nominal negative rates, that's pretty much the next place we'd go. And I don't know that America will go there. Some say it will, some say it won't. They're already in those spots in places in Europe, but that's besides the point. It really can't go much lower. Unless it goes negative, but it can go higher. So I'm not really a big fan of getting an adjustable rate mortgage whenever interest rates can pretty much only go higher, right? So if we're going to get an adjustable rate mortgage, we want to do it when the interest rate's high and it looks like it's going to go down. We're in a low interest rate environment. If I can borrow money at 3.99%, then I want to lock that money in forever. I want to lock that money in for 20 years at that rate, right? That's a really good rate. So whenever you get into commercial real estate, pretty much the difference is it's going to be a little bit more expensive, right? It's the first thing to know, but it also gets a little more complicated. Sometimes it could be easy. They could just say, hey, it's 20 years, here's your rate, and that's that, right? Now you're going to have a balloon. When am I going to pay this money off? Those things come into effect too. But then you start getting into other things in the commercial world. When you start to do bigger projects, you can say, hey, I want 2 years interest only at this rate. Then I want it to convert to an amortizing schedule after that. So you don't really see that kind of thing in residential real estate, but in commercial real estate, it's actually pretty common to negotiate, hey, this is going to be a 7-year loan on a 25-year amortization schedule, and I want to get the first 2 years of interest only. So what that does, if you've got a value add project, if you're doing some sort of construction or rehab, or even if you just want lower debt payments on the front side, you can ask for interest only. And that's really one of the big things about commercial real estate too. In the lending world is you can negotiate all this. In residential, it's cut, it's dry. Hey, here's the money that you can get out of this. That's my dog. Callie, come here. Ugh. Oh yeah, good girl. All right, hey, go play, go. Where were we at? Commercial real estate loans are way more negotiable. You can ask for whatever you want, and it's really up to the lender to decide if they want to give it to you or if they don't want to give it to you. And I'll give one example of how flexible and how negotiable things are. Whenever I was buying my house, I wanted a credit. To me, I negotiated a credit. I wanted some money off of the purchase price, but instead of getting money off of the purchase price, I asked for it in the form of a credit. Okay, so let's say I bought my house for $500,000. I asked for a $15,000 concession. I wanted a $15,000 discount. But instead of taking the purchase price from $500 down to $485, which would be a $15,000 reduction, what I wanted is I wanted that in the form of a credit, right? I wanted that money to come back to me in the form of a reduction of down payment. But in let's go over the quick numbers. Let's say I put 10% down on the house, then that'd be a $50,000 down payment. And if I'd have got a $15,000 credit, that would have taken my down payment from $50,000 down to $35,000, versus if I'd have just got a reduction in price of $15,000, that would have only reduced my down payment by $1,500, right? So there's a big difference there in getting a credit and getting a reduction in purchase price, because it's all about cash out of pocket. And so as investors, we always want to have as much cash as possible, right? So we can go out, we can invest in other projects. So essentially, in the residential world, the lenders will tell you things like, hey, you can't take that big of a credit. There are caps on how big of a credit you can take, because that's what this loan program specifies. That's what the residential laws are. You can't do that. Versus if we go over to the commercial world, I've taken $100,000 credits before, right? So instead of getting, a reduction in purchase price, you can get a credit. And you can take that as a reduction to your down payment, which is a really powerful way to put less money into bigger deals. And at the end of the day, for the seller, the person selling you that property, they don't really care, right? The reason they don't care is if I'm a seller and I'm selling a property for $1 million, and let's say that I'm willing to give a $100,000 discount off that, the money coming to me, it doesn't matter if it's a lower purchase price, or it doesn't matter if it's a higher purchase price, but instead of, you know, selling it for $900,000 instead of $1 million, if I sell it for $1 million and give a $100,000 credit, it doesn't matter. There's $900,000 coming to me at the end of the day. And so that's the importance of going into commercial real estate and knowing these different things. Is you're going to pay more, there's more options, you can negotiate more, there's a lot more flexibility, and there's a lot more moving parts, or can be a lot more moving parts, and you need to understand what all of those means. Now, one of the downsides, besides being more expensive, of getting a commercial real estate loan is that, you know, most of the time commercial real estate loans are almost always going to have a balloon. Okay, so in residential loans, like my house that I bought, other residential properties, you never have to pay the loan off, right? You do have to pay it off, but there's never a balloon due. So if we borrow $100,000 and we have a 5-year balloon, that means we're probably going to pay like $90,000 off in 5 years, maybe $85,000, depending on how much that loan has been paid down. But if there's no balloon, then we never have to pay it off. We just have to make our monthly mortgage payments for the rest of the time, and in 30 years or in 15 years, however long your amortization schedule is, you're going to be done. There's no paying it off. You don't have to refinance, nothing. And that's a really big benefit. Never having to pay your loan off, that's power. It gives you options. If you want to pay it off, you can. But to have the power to not have to go through that process, huge. Commercial real estate, almost 100% of the time, you're going to have to pay it off. A lot of times I've seen 3-year balloons, 5-year balloons are very common, and you can negotiate your way up to 7-year balloons. Now, some programs like USDA, SBA, there are some other loan programs out there that you never have to pay it off, and you can negotiate this, but banks are always going to want to get their money back. The reason that they want to do this is because if my money's sitting out there forever, and let's say that I lent that money at 4% and interest rates in the market go up to 6%, well, then I'm earning 4% when I could be earning 6%. I know it doesn't sound like a lot, but that's a 50% increase in profits that money that's out there is producing. So it's really important, because to go from 3% to 4%, from 4% to 5%, to us it only sounds like 1 percentage point, but to banks on the other side, you know, that is a huge boost in the amount of money that they can lend. Another reason it's a huge boost is because of the fractional reserve system, which says for every dollar in deposits that a bank has, they can lend out 10. Right? So really they're not making 4% on money. For every dollar that they have in their bank, they're making 40%. So they're going from 40% to 60%. So it can make a really big difference, and that's why they always want to have their money coming back. Even if the bank lends money to you on a commercial loan and says, hey, you know, you can have this money, you need to pay it back in 5 years, but in 5 years we'll give you another loan, and we won't even change anything. The only thing that's going to change is the interest rate. So that money, they're willing to lend it to you again most times if they have the money, if the credit market's good. But you know, they want to get that interest rate back up to the market, and sometimes they don't, because if interest rates drop, then you know, you're going to be paying less money overall. And so that's already a risk for them because of refinances. They can, you as the borrower, I as the guy who gets the money from the bank, I can choose if interest rates have dropped enough, if it makes sense for me to go refinance and get a new loan. But unless it's written in there, banks can't say, hey, pay me off, because interest rates have changed, right? So that's a big difference, and that's one of the reasons. So overall, commercial real estate loans are going to be a little bit more expensive. Sometimes they can be a little bit more tricky. You can negotiate more. There's more rooms to take credits. You can play some number games there as long as they're all legal. But overall, you're probably going to have to pay it back a little bit earlier. So those are the pros and cons of residential versus commercial loans. I hope this video was helpful for you guys. I'll see you in the next one. Subscribe to the channel, and see you in the next video.